Let's go ahead and get started. Welcome everyone to our Buckingham Investments 2021 SoCal Multifamily Investing Workshop. We are super excited to be with you today. This is the first time that we've done an event like this, a full day workshop. And we're really excited with all of the fantastic content and speakers that we have for you today. We've put a ton of work into this, and hopefully everyone is going to get a lot out of this. We've got some of the best people in the business practicing right here locally. So if you're interested and you've been thinking about investing in multifamily right here in Southern California, this should send you away with a really useful set and a variety of information about everything you're going to need to know to get going if this is your first time, or if you're looking to scale up and you already have property. We're going to talk a lot about some of that too. So we're going to talk about strategy, lending, taxes, a little bit on development, all kinds of stuff. If you haven't heard of us before, Buckingham Investments is a local real estate investing brokerage. We've got offices in El Segundo, Torrance, and Long Beach. We've been working here in Southern LA County and to some extent all over LA County, Orange County, and the state for over 50 years. So we have a lot of research going back decades and all kinds of great tools, analysis programs, planning materials and stuff like that that you can use to get going or to scale up your multifamily investment portfolio. We're a little bit different than what you might see out there on other educational platforms. If you came to us through a Facebook ad or some of the materials we had out there, then you noticed it said no upsell. So what that means is we don't charge for any of our education. It's all free, but of course, then the next natural question is, well, how do we make money? Well, we're a brokerage company, so just like a company that might help you list or buy a house to live in, except we specialize in investment properties, mostly apartment buildings here in the local area. So we do all of this stuff, all this education, consulting with our clients that are interested in working with us, under the expectation that if you do decide to invest here in our local market, we would love to be your broker, and then eventually we get paid through a commission. So that's how we make money. That's our business model. And we're happy you're here today. We're all about no pressure. We're going to give you all of the actual information that we use to make our own investments. Everybody that works for the company are also investors themselves. So when you work with our agents and brokers, you're talking to investors in our local market, and that makes us really unique and uniquely positioned to provide some great investing advice for you. So today, regarding format, it's not just going to be a 6-hour Zoom meeting. I know Zoom fatigue is very real. As we sit here, I'm looking at the date on my computer clock, and I see that it's March 13th. And I remember March 13th was exactly the day. That was a Friday a year ago. And that was the day that we realized that was going to be our last day in the office for who knew how long. So 1 year later, here we are. Coronavirus pandemic has changed everything in the world. It's certainly changed the investing space. It's changed the way we do business. Here we are in a virtual event. I don't even think I had a Zoom account before March 13th of last year. So we've got a ton to talk about. We have a lot of new developments to review from the year of 2020. We've got some information about where we might be going, some educated guesses perhaps on 2021. We have what's going on in the space for everyone here. One unique thing that we've done today to make this more interesting than just a regular Zoom meeting is we have a companion page to go along with this. And if Malcolm, can we put that in the chat? There it is. If everyone wants to, you don't have to open that now. If you happen to be on a 2-screen setup though, that's a great page to have open next to you. It's an agenda that's the same as what you see in front of you right now on the screen share. And each one of these sessions is hyperlinked. And we have downloadable materials that include market research. We have copies of all the slides. We have some quick reference sheets and educational stuff on each speaker's different topic that everybody's put together to share with you. So the idea today, this is why we call it a workshop, is you're not just going to sit here and listen to us talk for 6 hours, right? You're going to have a lot of great materials to download and take away and actually use. We have some very simple analysis tools on our website as well, but to use the really detailed stuff, you're going to want to reach out to one of our agents. On that topic, if you'd like to do that as well on that page, we have a scheduling app on the website through Calendly that would, if you want to set a meeting with a Buckingham representative, you can just pick a time that works for you and schedule that at any point today, just for a quick 30-minute consultation. Again, no charge, no upsell, no high pressure sales tactics. We just would love to start a relationship with you if you're interested in doing business in our local market. And if not, no big deal. I'm sure we can learn a lot from each other. So don't be afraid to reach out. We don't bite. So the agenda is super exciting. We're going to start off with kind of talking about strategy, and I'm going to do that for you. Then I'm going to invite Marty Stone on. He's one of our founders. He's been doing this since the early 70s. After that, we've got a lending panel discussion with lenders that play in all different segments of the multifamily space, from duplex owner occupied stuff to 100-unit plus large buildings that you might raise funds for and put together a syndication to buy. Then we have Matt and Amanda Hahn, or Matt McFarland and Amanda Hahn. They are CPAs. They're my CPAs. They are absolute experts in tax issues for real estate investors. And then we have Jeff Jeanette, who is an architect in Long Beach, and he specializes in all kinds of construction for residential properties, but he's a particular expert in ADUs. So if you don't know what that is, definitely join us for that. And then, of course, we've got Michael Borba, who's got some great presentation items on how property management went during the pandemic, what he's had to do to change his operation moving forward. He's got about 3,000 units under management in Southern LA County. He's our go-to property manager for a lot of our clients. He manages my own buildings. And then we're going to wrap it up with an economic report and all of that market data that I'm sure everyone is curious to see at the end. Since this is a Zoom meeting, you can drop in, you can drop out. If you need to go do something else, you can join us for whatever sessions you're interested in. We'll just leave the link out there. If you're watching us on Facebook Live, this will just be going all day. If you are on Facebook Live and you'd like to jump into the Zoom meeting, we encourage that. We're going to have some networking breaks throughout the day as well, where we'll do small breakout rooms and you'll get to meet each other. I'm sure there's a lot of people that we haven't met here. And then we'll have little icebreaker questions for you as we go into those breakouts. We're going to take a break for lunch, along with a little networking at 11:45. So hopefully that makes sense. Malcolm, did I miss any logistics that we need to cover before we jump into the initial presentation here?
I think you got it. I think we're good to go.
Excellent. Okay. Well, here we go. So I'm going to go ahead and share my screen. And let's talk about strategy. So this is the main piece here. It makes sense to start at the very beginning and talk about why we're here to begin with. So let me make sure we can see everything here. There we go. Can everyone see my screen now? All right, perfect. So a lot of people like to focus and get caught up in all the little details about investing in rental property. I'm sure you've been all over the internet reading articles, downloading calculators, talking about cap rates, GRM. Perhaps you're syndicating deals and you're thinking about limited investors and general partners and legal entities and all that kind of stuff. But there's actually not a lot of time that we spend focusing on the basics. So before we get going into a lot of the details here, I want to back up a little bit and just talk about strategy, because this is really the most important part of anything we do. So this is going to be very high level. The numbers are going to be basic, but we're really going to focus on the long term and why investing works here. So if you already know this stuff, I challenge you to just go through this thought experiment with us for a minute and challenge some of your assumptions a little bit and think about where you are. We're going to talk a little bit about writing an investment plan here too. We'd love for people to walk away with a plan on what they're going to do this year and have some hard numbers so you can go ahead and execute on that. So first, a little bit about me. My name's Anthony Walker. If you haven't met me before, I'm the CEO of Buckingham Investments. I've been in LA since 2000, hard to believe, 21 years now. I moved out here from Minneapolis. And I worked a corporate job in the insurance industry for almost 10 years. That just didn't do it for me. I didn't think I was going to be happy looking back on a 40-year career of that. And I just certainly don't think it was going to help me retire early. So I went to business school to figure out what I could do with myself, open a business. And my criteria for what business I wanted is I wanted something that was going to be scalable, deliver passive income, and require a minimal number of employees. So real estate was perfect for that. I was fortunate enough to be introduced to Marty and in 2010, and I started with Buckingham as a client while I was still in my corporate job. I bought my first little duplex right here in Long Beach on 10th Street. Around that time, it was $300,000. Actually, the picture looks better than it really was. It was kind of rough, but it did its job. Owned it for a while, exchanged it into this 5-unit, also a real looker, 100-year-old building right down the street in Long Beach. Owned that for a while, exchanged it into this, and now we're kind of talking. This is a little more like it. When you think apartment building, you might think of something like this. This is an 8-unit building in Long Beach. Since then, this is a number of years ago, I have refinanced, I've exchanged, I have bought more properties, and with the one that I just closed on last week, I own 15 buildings now, a little over 100 units, mostly Long Beach, but some, I just got one in Inglewood actually. So Southern LA County is my focus. That's where I like to invest. And I can tell you firsthand that this investment philosophy has completely changed my life. I get to work now with Buckingham because I want to, not because I have to. So with that being said, let's back up and talk about why we're all here to begin with on a Saturday. So we need to do a little bit of math before we get into the details. So this is the time value of money equation. If you haven't seen this before, it is the math that's behind all investing that compounds upon itself. So what I mean by that is if your money works on itself after you place it, this is the formula that's at work. So this works for a savings account, mutual funds, real estate, you name it. And we need to understand this formula a little bit in order to make sense of how we're going to make a return in real estate. So if you read it, the variables are future value equals present value times 1 plus the rate of return to the power of n, where n is the number of years that your investment compounds. So in plain English, the value of an initial investment today, which would be your present value, is equal to 1 plus the rate of return you're able to achieve to the power of n, where n is the number of years your investment works for itself, and then that's your money in the future. If you know any 3 of these variables, then we can solve for the 4th, and that's what a financial calculator does. The great thing about this equation is it has this exponential curve to it. So if you put this on our little cocktail napkin, the longer your money works for you, the faster the value of your equity in this case accelerates every year, and is by far the most sensitive variable in this equation. So you really just want to get your money working for you as early as possible. And then of course you want to try and maximize your return. The rate of return is what determines how quickly the graph accelerates. So if you had money in a savings account, it's going to go like this forever, and after a few hundred years, you're going to be rich. But most of us don't have that long to wait. So we got to look for stuff like real estate that can give us an unusually high rate of return without taking on a lot of risk. So we're going to show you all about how to do that today and unpack that. You can also take this equation, and if you turn it into a word problem, it becomes the beginning of your investment plan. So we call this your general investment plan. So if you take nothing else away from today, this one sentence is going to change your life if you put some thought into it for your own self. You could say, I'm going to invest present value dollars for N years in real estate investments at a sustained rate of return of R%, and I'll be worth future value dollars at the end of the plan, right? It makes a little more sense once we're there. So we have a pretty good idea of how much we're starting with. And from there, we can actually estimate what our expected rate of return is going to be. And then we can ask ourselves, how long do we want to wait till we want to be financially independent? And then how much are we going to be worth? Or we can calculate how much we want to be worth and calculate how long it's going to take us to get there. Or we can calculate what rate of return we have to hit over a given number of years to be worth future value dollars at the end of the plan. So let's just look at some sample numbers here really quick. We've got, this is a financial calculator on paper, so to speak, or your screen. So super rough. You can get these, you can build one in Excel. We've got a really basic one on our website that you can use. There's all kinds of online financial calculators and apps. But basically, your present value is over here. Your number of N years is here. Different R numbers are here at the top. And then the future values are in this matrix. So as a little example, let's say you had $200,000 to invest. That's going to be a down payment on like a 3 or 4 unit building in a lot of the areas that we work in. In 10 years, if we can get 25% return on that investment, then it's going to be worth 1.8 million after that time. That's your equity in your real estate portfolio. At any given time, you should be able to make about a 5% passive cash return on equity from this number in the future. So that's going to be your retirement income or your financial independent income as you're planning and doing your math. So after 10 years at 1.8 million, you make a little over $90,000 a year. That's all fine and good. But in LA, that doesn't really do it, right? To be financially independent for most people, unfortunately. But look what happens in the next 5 years. It goes to 5.6 million in only 5 more years. It triples. And then in another 5 years, it goes to 17 million. So if you do the math, after 15 years, 5% of 5.6 million is, what's that, over $250,000 a year in passive income. Now we're talking. And so what you're seeing there is the shape of this graph in those numbers. So when we say just you want to start as early as you can, manage those returns, and you're going to be really happy down the line, that's what we mean. The beginning, the first 10 years is the not very exciting part, unfortunately. So you've got to focus on your goals, focus on the payoffs, and then you'll get there. Where I am with my portfolio right now, I bought my first property now, I guess 11 years ago, first multifamily at least. I bought my original first property in 2006. I'm just starting to kind of achieve liftoff, and it's getting really exciting for me. I can do multiple transactions a year. I've got great cash flow, but it took a really long time to grow to that. So you got to be patient. Now, I know a lot of people might be looking at this chart and saying, yeah, but you're showing us a chart that starts at a 20% return on equity. That's ridiculous. And I understand that looks ridiculous at first, but we're going to unpack that a little bit and show you how this works. So when you invest in a piece of real estate, it's a little more complicated than putting your money in a savings account or something like that. You have 4 elements of return. You have appreciation, cash flow, equity buildup through amortization, and tax benefits. Sorry, I'm going to move our agenda over here just so I can keep track of time. There we go. Okay, so if you add all of these together, that's what gives you that R number. And each one of these returns are useful for different things. So cash flow obviously is useful for spendable income. Appreciation is better for building wealth. Equity buildup through amortization is the principal pay down on your loan. So if your tenants are paying your loan for you, it pays down the balance of your loan, and that becomes equity. And then great thing about real estate investing, you get tax shelter benefits too. So you get to depreciate the value of the property and write that off versus your cash flow. If you're a full-time professional, real estate professional, you can even offset active income. We'll let Amanda and Matt get into that later. It gets very complicated. And then you can do 1031 exchanges. If you owner occupy the property, you can exempt gains. You get really favorable tax treatment when you invest in real estate. So add all that together, and that's that R number. But the interplay between these different returns is important when you're selecting your properties and what's important for you in your own investment plan. So let's look at that. We'll talk about appreciation first. So Southern California is really mostly an appreciation game. The strategy here makes a lot of sense to build wealth over time. And our market is uniquely positioned to allow you to grow a lot of wealth relative to what you might be able to do in some other markets of the country. So here at Buckingham, we are fortunate enough to have over 50 years of values. We've been doing this research since 1965. Our company was started in 1963, and we've been keeping track of local closed sales data going back to 65. So what you're looking at here is a price per square foot on average of 2 units and above in what we call the Greater South Bay. So that would be from about Inglewood, like LAX area, down through Long Beach. We have these numbers from the rest of LA too, so we can show that to you if you're interested. I believe we have that stuff in the downloads, at least what it looks like recently. So make sure to check that out if you're interested in the rest of LA. But in 1965, if you can read this, we were at $14 a square foot. Hard to believe. In 2020, we ended at $422 a square foot on average for multifamily property in this market area. Our 55-year average rate of appreciation during that time every year was 6.4%. So if you'd bought in 65, one property and held it to 2020 and you just hit the average, you would have made 6.4% just from appreciation on the value of property alone on average every year. Now, obviously real estate is susceptible to the same business cycles that we see in the economy. To some extent, prices go up, prices go down, but there's some important trends here that you want to pay attention to. You notice that every time we have a downturn and then we have a recovery, we always surpass our previous high. So if we keep that in mind while we're making our investment decisions and we buy for the long term, so we're never forced to sell, you really never have to realize any losses. Now, people get in trouble like they did in 2008 in the subprime crash when they take on too much debt, and then you do have to realize losses if you say get foreclosed on or you get in trouble and you have to sell property. So you want to stay careful enough when you're buying so that the property is always going to pay for itself, at least once you get it stabilized, right? So we can definitely help you with those details. That comes down to like what kind of property you're going to pick. So lots of interesting stuff in this chart. We could talk about this for a long time. But we're going to use these numbers to make long-term forecasts for how our investments might perform over the years. So obviously, we don't know what's going to happen in every next year, but if we have 50 plus years of data, we have a pretty good idea of how long-term values are going to go. And this chart really looks like this uniquely here, because if you think about a map of the LA area, we have ocean on two sides, mountains to the north, and 100 miles of city to the east. Virtually no room to add any additional significant amount of supply without building up. So you do see that in the downtown areas. We're building luxury units. They're really expensive, but it's stuff that's for workforce housing, middle income, lower income housing. It's really difficult to build that. So what happens is we get this supply and demand imbalance, and values do this over time. This chart would not look like this if you took a random market with lots of room to build in the middle of the country. So you have to watch that depending on where you're looking to invest. So from there, let's do a simple example to illustrate the power of what we call leveraged appreciation. So leveraged appreciation is the idea that most people are going to use some of their own money as a down payment and a lot of other people's money, which is in most cases from a lender, to buy a piece of property. Now, when you do that, you get all of the increase in value is your equity, not the lender. They don't get to participate in that. So the math behind that effect is called leveraged appreciation. It's most easily explained with a simple example here. So if you buy a property all cash, let's say you have $300,000 to invest, and that goes up at 5% in your average year. Just for a conservative estimate, that's just us knocking it down from that 6.4 number. In year two, your property would be worth $315,000. And if you do the ROE math there, it's 15,000 divided by your down payment in year one, which is 5%. If instead, though, you put the $300,000 down and you bought a $1.2 million building, that gets you a nice size 4-unit in a lot of the markets we work in. That 4-unit goes up by the same rate, 5%, which is $60,000. And in year two, it's worth 1.26. So the math is a little different now. $60,000 is your return from appreciation divided by $300,000, which is your down payment, not the purchase price. So your ROE from appreciation in this example is 20%. That's only from appreciation. So all of a sudden now, that chart I showed you that started at 20% return doesn't look so crazy when we consider that we also have cash flow, amortization, and tax benefits to add into the mix. So this is the magic of investing in real estate, leveraging appreciation. Now, you don't want to take on too much debt, and you have to pick the right property so that it's not negative every month, and we can certainly help you with that. But let's take a look at this as we chart this out. what happens is you can't just buy one 4-unit property and, with $300,000 down, have it worth whatever, 10, $15 million in 20 years. That's not how it works. And I think, intuitively we understand that. But here's why that doesn't work. And here's what happens. So in the first year, here's that math we did in the previous slide. If it keeps going up at 5%, this is just average year math, remember. In the second year, it's worth 1.26. We get a $63,000 increase. And the math in year 2 is 63,000 divided by 360,000 in equity, because we had our original down payment plus the equity increase. Now, that's only 17.5% ROE. So what's happening here is that as your equity grows, your ROE goes down because the denominator in the ROE equation is growing. So this is why you can't just buy one property, sit on it forever and be, worth $20 million. You have to do something about it. So if you write an investment plan that takes that into consideration, you can re-leverage your return, so to speak, when it gets too low by doing either an exchange or a refinance. So here's the same example, but now we're doing a 1031 exchange. A 1031 exchange is an IRS rule that allows you to sell a property, and as long as you buy another property of equal or greater value within 180 days, subject to a whole bunch of other rules that we can get into, then you don't pay capital gains taxes. So here's that first property. If we sell that property after year 4, and we put 558 down, that's 489 plus 69,000, and we buy a new property for 2.2, look what happens. We put 25% down again on 2.2, and our ROE's back up to 20%. So if we continue to do this, we can keep our ROE high throughout the life of our portfolio. Pretty amazing, right? And you can average an ROE from leverage appreciation pretty conservatively at 17%. That's just from 5% appreciation over a long period of time. So instead of $300,000 going to 2.3 million or so in 20 years, $300,000 ends at 6.7 million in equity, 17 million in property after 20 years. Now, that is a pretty big difference. So let's compare how that might look on a chart. So here's what it looks like if you buy one property and you sit on it without doing any exchanging or re-leveraging. Here's what happens if you buy multiple properties and you continue to exchange. By keeping that rate of return high and not getting deleveraged over time, it gets really powerful. Now, mathematically speaking, you don't actually even need to sell the properties as you go along. If you buy properties and you like them and the returns are good and they're stabilized, you can keep them, you can refinance, you can take cash out and you can buy more, and the math is the same. So if we go back here, we could have just refinanced this building instead and bought a second property, and you would have 2 properties worth 2.2 total with this amount of equity. The math is the same. So you don't necessarily need to sell properties, but there's some additional analysis that you can do as we're working with that. Now, those examples only used just appreciation alone. So remember, we talked about 4 elements of return. It's beyond the scope of this quick little presentation to get into the details of that. And we can do detailed pro forma and forecasts of every element and, do sensitivity analysis on any property you might be looking at. But if we just boil it down to say, a simple assumption that if we've got 5% average appreciation plus 3% additional return on total capital from cash flow, amortization, and tax benefits, we can probably get an unleveraged 8% return on the value of property. So with an unleveraged 8% return, here's how the numbers look. Same strategy, same exchanges, but this would assume you're reinvesting cash flow, paying down loans, saving the amount you saved in tax benefits, and using that to reinvest as well. You can get your ROE into the mid-20s throughout the life of your portfolio. And here we are, 300,000 to 26 million in 20 years. So at any point, remember, you can take 5% of this number, and that's probably a good estimate for what your passive cash return on equity is going to be. Plus you have all of this net worth to tap into if you need to sell something or, pull out cash, buy a house, something like that. So really powerful stuff. These numbers look ridiculous. I understand that, but this does take some discipline and paying attention to what's going on in your portfolio and doing the math on an annual basis to make sure that your money's working as hard for you as possible. We meet a lot of people that have let their portfolios been deleveraged. They bought a few properties and now they're kind of wondering, well, when does this get exciting? Often it's because you've owned them for too long. They've gone up in value a lot and there's a lot of meat on the bone there and your ROE has gone way down. So if you're interested in talking to us about doing a portfolio analysis so that we can optimize your returns, just book a meeting there in our little Calendly app and we can help you with that for free. Pretty powerful. So let's look at the graphs on this. Without exchanges, the green line. With exchanges, 6.7 million in equity. 8% return with exchanges, $26 million. It's worth it to pay attention and re-leverage appropriately, right? So, what gets a lot of people into trouble with this stuff is they take a stock market mentality to real estate investing. We go to a lot of networking groups, meetups, and talk to a lot of people, and everybody wants to buy low and sell high. And I understand that because a lot of people have come from investing in stocks. Well, with real estate, that attitude can get you in trouble. So let's compare the S&P. So here is the S&P return since inception, 63 years ago. It started in 1957. Total annual compound return on the S&P was about 7%. Number of companies still in it this was actually as of 2007, only 86. So 500 companies, 86 still in it. You had a 17% chance if you bought S&P 500 stocks in 1957 that the companies you bought would still be in business today. Pretty wild, right? So of course you're going to try and you got to be really careful when you're making those types of investments. Now with real estate, it's a lot easier because most of these properties are all still here. So what this does is a lot of times when people take that attitude to real estate investing, they feel like they have to get the very best deal possible in the market. So we call this the dilemma of a good deal. And here's a little study that we've done. So we've got all these records of sold properties going back to the 70s and 80s. We picked 2 4-unit properties in Hawthorne, California that both sold in 1989. These are really similar buildings, right? And arguably, the Acacia Avenue property was the best deal for this type of property in 1989, and the 118th Street property was the worst deal in 1989. That's the down payment that it took to make each one of them. And in 2020, the similar properties were worth about 1.6 million. So if you just bought one, held on to it, resold it, you would have made 1.1 million versus $1,075,000 in proceeds. So the difference in the return for getting the best deal on the market was less than 1%, about 0.5%. Pretty wild. So now what if, as you did that, in order to get the best deal possible, you waited a year and you bought in 1990? You could then execute those exchanges like we talked about, re-leverage your money and be worth almost $7 million. Fantastic. Okay, you did good, but you waited a year to buy the best deal possible. What if you bought the worst deal as soon as you found it and you had a year's head start? The way that the time value of money equation works, the compound interest formula dictates because you have 1 extra year of your equity working for you, even though you bought the worst deal at the beginning, your equity is now almost $9 million because you had 1 more year. Each additional year, this far out, 30 years out, you're making millions of dollars in value add because of how much your portfolio has grown. So this is an illustration of how important that end number is. I can't tell you how many people I've met that have just been waiting for years to get the best deal. And if you've been waiting for like 4 years, 5 years, properties have almost doubled since then. So you're leaving a lot on the table. Another problem that people find themselves in is thinking that you have to buy in the nicest area possible in order to make money in real estate. So we've got a great little example here. So here is a duplex in Lawndale. And if you don't believe us, we've got the MLS cards right here that we took out of the box that's been sitting in the El Segundo office since 1980. This is what the MLS used to look like. Here's that building. This is the actual card from 1980. You can see it's the same property. And it sold for $95,000 at that time. In 2020, a very similar property sold for $836,000. Okay, so that's one area. Lawndale is, good investment market, kind of, middle income, good renter market. Nobody would say it's the nicest area in the South Bay. Now, how about at Hermosa Beach instead? Right? Most people would say, well, I wanted to own the Hermosa Beach property. Here's the Hermosa Beach property. Same guy right here, sold for $260,000 in 1980. So most people, when they see, oh my God, you could have bought something on Manhattan Avenue in Hermosa Beach in 1980 for $260,000. That would be the one I want to buy, not the Lawndale property. And of course, a similar property in 2020 is now worth $3.8 million. So you really hit it out of the park. So we got to go try and buy something in Hermosa. Well, not necessarily. If we do the math on this, in Hermosa, that $260,000 property, it did appreciate more than Lawndale. It did, by about 1.5%. So yes, the appreciation rate was higher, sold price was higher, profit was higher. However, the cash it took down to break even on that property at the time of purchase was 50%. And in the Lawndale property, you could have bought this one with only 25% down. And for the same amount of money, you could have bought 5.4 Lawndale duplexes. Not that you would buy 0.4 duplexes, but the example makes sense. And all of a sudden, the math looks very different. Look at your profit in Lawndale, $500,000 more than it would have been in Hermosa. So what if we take those numbers? This is now 40 years of math, and we extrapolate that forward, okay? Here is Hermosa with exchanges at the same, assuming you're having to continue to put 50% down. So you begin being deleveraged every time you buy in Hermosa. And here's Lawndale with leveraging appropriately. In 40 years executing on that strategy, it's the difference between being worth somewhere around 25 million and over $200 million buying the properties where the leverage makes a little more sense. So it's counterintuitive, but you got to do this math. So with that being said, let's back up even further. It's really easy to focus on deals, talk about areas where we ought to buy and technicals. But at the end of the day, what's going to get you to move is figuring out why you're here on a Saturday listening to us and why you're interested. So a lot of people skip this step and they just want to make as much money as possible. And I get that, but don't skip this step. We're not doing this for a bag of cash. We're doing this for what the cash allows you to do. And don't skip planning for that. So we have a great little resource for this. We call this the planning workbook. It's available in the download section on this first initial segment if you're on our website. And there's a whole little exercise you can go through to quantify your goals that then allows you to hit those future value numbers. This is what an investment plan would look like, and we can help you write one. Honestly, the most important elements are the goals and this general plan. That was just that one sentence. The goals by far are the most important piece, because if you don't know what you're shooting for, then what are you doing? That has to dictate your investment decisions, right? It's going to differ depending on what we're trying to accomplish. The detailed plan is interesting, and we can work on that. But honestly, whenever you're doing investment planning, we're kind of using average year numbers anyway, and we're never going to be able to get it exactly right on how much your property is going to cash flow or go up in every year, especially as you get a few years out. So, the detailed plan is for kind of estimating what things might look like in the future. But the most important thing is this goals and this general plan, and then the follow-up to make sure you're checking your portfolio, do a little bit of backward looking analysis and make sure that you're not deleveraged. I do this every year on my properties. This keeps me disciplined, and it tells me when I need to do transactions. So before I bring Marty on, I wanted to show this slide as we get into a little more numbers. There's a lot of conjecture and talk out there right now about where the market might be going. This is a unique time in history. The pandemic changed everything. We all thought that we were going to go off a cliff in March and April, and that's not at all what happened. Instead, we appreciated. Interest rates are way down. Everyone's really worried about inflation coming back in a big way, because we're now, with the latest stimulus, what are we at, $6 trillion or something getting pumped into the economy. So it's been a long time since we had anything like that happen, interest rates going up and inflation coming back. And a lot of people that are investing these days weren't around for that. So I wanted to show this chart real quick. And illustrate this. In the 1970s, we had big inflation in this country. $17 a square foot. This is just from that market study, going to $86 a square foot in 1981. And to try and get that inflation under control, interest rates went from 7% to 16% in 1981. And so the standard thinking on this is, oh yeah, when interest rates spike, values are going to go down, but that's not at all what happened. So it's really interesting. During this time, actually, values went up by 406%. And if we look at this on this larger scale, check this out. This boom doesn't look as big as the subprime boom or even as the one that we're in right now, but on a percentage basis, it was much larger. 406% is much larger than 114 to 329 or 205 to 422. So with that in mind, I'm actually going to bring Marty in because we're running out of time on this segment, and then we can look at questions in the chat, and Marty's going to give us a little bit of his memory on what it was like investing in the 70s and the 80s. So Marty, looks like you unmuted. What can you tell us about what was going on during that time?
Can you hear me?
Yeah, we can hear you.
Okay. So I made some notes as you were talking, and I wanted to tag team off of the chart that you just showed everybody. And because I was there buying during that time, and it's crazy that my memory is that during those times when things were going up so crazy and the interest rates and all that, when you're living through it on a day-by-day basis, it doesn't seem as enormous as what that chart showed. That's my first memory, is because this was affecting everybody. So everybody was in the same position. So when you look at it in reverse, it looks crazy. And you made the comment that the interest rates went up to control inflation, right?
Right.
Okay. So this, as I'm listening to that, what I remembered was, and I made some incredible investments during those years where property went up over 400% in just a few years. But those were in my youth, and I really got excited about building. So what I did was I got my contractor's license.
Oh boy.
And I started building. Well, and during the 80s, I built 50 apartment buildings and commercial buildings through Buckingham. It was a company business. But the incredible thing is, as I look back, when people think, how can you make any money at that number was 16.63%, right? Well, I can remember at the end of that recession run-up, I had to refinance a 3-unit building to pay this private party off that I had borrowed, and I paid 18.5% fixed rate on a 3-unit building that I owned in Inglewood. But even more incredible is when I started building, I had 50 construction loans during those building years, and every construction loan I had was over 20% interest. And even paying 20% interest, the profits we made during those times were astronomical. So it's counterintuitive that high interest rates mean you're not going to make any money, because we got going in the 80s and we were building like crazy, and we were getting huge leverage deals on the land, and the contractors were willing to work because the economy was slowing down. But as far as from a profit center, we made a ton of money during that time. So that was some of the best times in my memory. And when you look back, I mean, that we were paying a higher interest rate than you pay on a credit card, and that was on bank loans, and we were still making. And we were refinancing out at those huge rates and still making money.
Wow. So
that was my first thought. The second thing I wanted to add, because I was taking some notes as you were talking, and I wanted to emphasize again what you have emphasized is you got to make those, when you first get started investing, if you make those goals really personal, not the bag of money. I love the screen that you had up, because you had the bag of money and then you had the catamaran on the beach. And if people will look at the my picture that you put on the screen, it's a picture of me on the Star Flyer ship. It's a 350-foot sailboat. It's a it's a 350-foot sailboat. I've been on that boat on 6 different cruises, and it's a 4-masted real sailboat that really sails. And the last trip we took was to Bali, and that's a picture of my wife and I. We one of the stops, because that boat only goes to the small places that the big boats don't go. And we went to Komodo Island in Bali, and we got to walk in the forest on Komodo Island and see the Komodo dragons. And that was a picture we took with one of them. That guy was about 8 foot long, and he was well fed. So we were okay, because they're meat eaters, and you have to go with guards. But it's really important to make those goals to start with, because like you mentioned, when you get started investing, it's a slow start.
Yeah.
And you're doing something new that you've never done before. So it pays. It's like, if people can go back and remember when they were a kid, when they got it in their mind that they needed a new bike, or I grew up in Minnesota like you did. If you needed a new pair of skates and you had to earn the money to get it, I mean, that's all you could think about until you got that new skate or that new bike. So if you just, it wasn't about the money that you worked hard, it was about what you could get with the money. And that's why it's so important that you make all those goals very personal. And the more of those you can build in, the more successful you'll be in the long run, because you're not doing it for the bag of the money. You're doing it for creating that, having a good a life, a happy life. I made some notes last night. Having a lot of money won't make you happy, but if you know what will make you happy, money can help you get there. And that's the way I've always looked at it.
It's great advice.
And the other thing I wanted to mention, because through all our analysis, we talk about appreciation, and people who pitch other investments in life, like the S&P 500 thing that you talked about, they'll always tell you, well, real estate, it's all about appreciation. You can't count on it. Well, the thing that people have to remember is appreciation is a word that some economists invented for why real estate goes up in value faster than the rate of inflation. And that's because real estate is affected by inflation, just like everything else in our world is affected by inflation. But real estate gets an extra push because of the demand. And you started off your talk by talking about how LA is a closed community. There's no vacant land. So people, and we keep making more people. So we've got more people trying to get the same inventory of property. So the demand pushes up the prices in our area a lot faster because of demand than just inflation. Whereas you can go to my sister just moved to can you still hear me?
Yeah, we can hear you.
Also, there's some noise in the background. My sister just had to leave California. My brother-in-law passed away, and she had to move to Alabama because she could no longer afford to live here. Well, she bought a really nice 3-bedroom, 2-bath home in Alabama for $50,000. That's because there's millions of acres of land in Alabama, and there's not a lot of people there, so the demand isn't there. So you can have negative appreciation, or very low appreciation, even in high inflation. So I wanted to add that to the mix. And The other point I wanted to make, which is I think is critical because of all the, we've got all these new rent stabilization and control things that are kicking in California, and what you have to do if you want to see how that really impacts the thing that we invest in is just know that the oldest rent control in America is in New York City, in New York. And New York, it's had the oldest, and I don't even know how far back it goes, but I'll tell you a quick story. I built 3 buildings for a couple of investors from New York in the 80s, and the one guy, now remember this was in the 80s now, and the one guy said, I have a rent control apartment in New York City, and the rent can't go above $150 a month in my lifetime. So it had a lifetime, and he said it would rent in the open market for $3,000 a month, and this was in the 80s. But I rent it to a friend for $1,500 because I live in another place. And despite rent control, New York still has the highest real estate prices in our country, and it has the highest rents in our country. And San Francisco is right behind it. It's the next oldest rent control, and we know what the things are there. So in reality, rent control doesn't really have a significant long-term effect on anything we do. It's just one of those things you have to learn to live with. But in reality, most investors get lazy and they don't raise their rents every year. Whereas when you get in a rent control environment, you will raise your rents every year as much as you can. And it forces you to raise your rents. And it basically keeps your vacancy rate to 0. And it lowers your maintenance costs because people don't move. And when they do move, it's like Christmas in July because you get to raise your rents up as much. So I wanted to make that comment. And we did a study, if your people want to see it, Anthony, when rent control actually hit in 78 in LA City. And I pulled some of our old charts, and I had the San Pedro chart, the Hawthorne, Lawndale, and Inglewood charts. And from 78, when rent control started, to 80, the chart I had cut off in 84, in 84, and of those 4 cities, the San Pedro property values went up 84%. They were the highest. Hawthorne 54, Lawndale 28, and Inglewood 81. So it had no negative effect whatsoever on value increases. So
yeah, it's interesting how that worked out. I'll put a link to that study because it's deep into our website from when the state just passed their rent control right now. So if you want to see those numbers, it's interesting, right? You could make an argument that rent control is good for the investor.
Oh, it is. How can you say anything different when you look at what's going on in New York City?
Right.
It's real easy to get on the internet now with Google and type in what's the average price of a 1-bedroom apartment in New York City, and it's a pretty big number.
Right.
And then type in what's the average price of a 1-bedroom unit in Long Beach, and it's a lot lower number. Right. So, and then you type in what's the and Santa Monica has the worst rent control in the whole nation, no doubt. Right. If you type in what's the average rent for a 1-bedroom in Santa Monica, you'll be amazed how high it is.
So we have an interesting point here from Kathy in the chat. She says, interesting, I would think rent control would impact monthly cash flow. Is the current comment based on long-term returns? And yeah, we're really talking about values, but what it does as well for the market is it distorts, it creates inefficiencies in the purchase markets for properties. So like if you're looking in the city of Los Angeles, for example, there are a number of investors that understand the LA rent control really well, and they specifically target buying properties that are below market rents, because the rent control is so bad. Those buildings that have way below market rents trade at a huge discount.
Yeah.
And you're right, at the beginning, you're not gonna make any money on cash flow buying that type of stuff. In fact, you might lose money. So you have to be well capitalized, and you have to know what you're doing to buy that sort of stuff. But if you can get a huge discount on it because of the returns that you're able to get, then it makes a lot of sense.
And Anthony, one of the things that you pointed out when you're looking at your goals and all that, I think it's fair to say that that most people who have the financial wherewithal and the money to invest in real estate, their minds work like they were taught in school, that your investment has to pay for itself every month.
Right.
But in reality, the kind of people that have the financial wherewithal and the money to invest in real estate really don't need cash flow. It's just something that they were trained to look for. So the point you just made is a really good one. You find a deep discount on a building that's way under rented, and you're buying that investment not for the fact that you have to put more down to make it break even, but for the fact that you put more down to make it break even, but then you use all the strategy necessary to get all those tenants up to the real market rent. And then you've got a real winner, because then you go in and refinance and you buy 2 or 3 more buildings.
But it all depends on who you are, right? So this is why we talk about picking the right deal.
Yeah.
So yeah, if you don't have the kind of money and time to do that, you don't want to do those kinds of deals.
No.
Right. And there's something for everyone there. There's plenty of deals that will cash flow on day one and allow great leverage, and then you can buy it and forget about it, and it's going to make you money. We're not advocating that that's the only strategy and the right strategy, but there's a way to make sense of buying anything between buildings that need tons and tons of work and had a fire damage and are rent controlled, right? And something that has strong cash flow that it's going to give you leverage right up.
Yeah, I can tell you that I've been in the business a long time as an agent and as an investor. Excuse me. And because I'm a licensed real estate agent, I have a fiduciary responsibility to anybody that I work with in real estate, including someone I might want to buy a property from. I have a fiduciary responsibility to them. So I honestly believe, if you use the word deal as something that has an extraordinary benefit to the price you're paying, I have never been able to purchase what I would classify as a really good deal because of the constraints I have on me as a real estate agent, and the fiduciary responsibility I have to anybody that I might come in contact with in the real estate business, even if I'm going in as a principal.
Right.
So in the long run, it just, your slides told the story. You buy the worst deal or the best deal in the long run, you're going to make a lot of money. And the key thing that I've found over the years, if you use sound business decisions when you buy, even through those tough times, things are going to work out okay for you. You won't put yourself in a position where you're going to have to sell something at a fire sale now things happen to people in their personal lives that might have a big negative effect on their investment property. But generally speaking, if you don't get stuck in that position, if you use sound business judgment when you buy, according to the plan you've laid out, things are going to work out really good for you in the long run. And we've got so many clients that have done well. I'm not pitching the latest book that I wrote called Real Estate Investing for Everyone, because I have to be honest with you, the company, the publisher that hired me to write that book just went bankrupt. So I don't even know if they're printing the books anymore, but if anybody cares to get a copy, and you might have some, there's testimonies in that book from some of the people that I work with over the years. And some of if you read how things have worked for them, you'll see that real estate, it works really successful if you just get a plan and work it.
Awesome. Well, Marty, thank you so much for sharing some of your experience over the decades with us. It's been great. We're at 10:02, so we're a little over time.
Okay.
We've got to get on to our lending panel. So
Okay.
thanks so much for joining us. It's been
I have to leave anyway because I've got to pick up my grandkids and have a good time today.
Well, have a great time. We'll be here talking about everything you've already done.
Okay.
All right.
Bye,
See you, Marty.
everybody. Bye.